Hi, my name is Mike Turner, and I've developed a set of rules. I call them my 10 must-follow rules for beating the market. Rule number one is to think like a fundamentalist. This is the rule that tells you what to buy, not when to buy. But here's the important part of this rule. You do not want to buy a stock because of fundamentals. And I want to explain what I mean by that. And you're probably used to, if you're a fundamental type investor, you're probably very used to looking at the fundamentals before you would even consider buying a stock. But far too many investors buy a stock because of the fundamentals, and this is wrong. I know you want to look at the earnings, you want to look at the revenue, you want to look at the return on equity, you want to look at the PE ratio. All those are important. But those are reasons for considering a stock, not buying a stock. I'm going to get into when to buy a stock in rule number 3, but in rule number 1, this is all about the fundamentals that you want to consider before you would even look at buying a particular stock. Let me give you an example of what I mean. Let's say you've got two stocks, and I'm going to call it stock A and stock B. A year ago, stock A had 10% earnings, the best in its peer group. Stock B had 1% earnings, the worst in its peer group. Okay, this year, stock A hit it out of the ballpark again. It had 10% earnings, the very best earnings in its entire peer group. Stock B, yeah, it did a little better. It did 1.5%, still near the bottom of its peer group. Now, based on that and that alone, which of those two stocks do you think you should consider buying, A or B? Far too many investors look at stock A. They say, oh, it's got the best fundamentals. It's a far better company. And indeed, stock A is indeed a far better stock. It's a far better company. But it is not the stock that you want to buy. Why? Think about it. Last year, stock A had 10% earnings. This year, it had 10% earnings. What was its earnings growth? 0%. Last year, stock B had 1%. This year it has 1.5% earnings. What was its growth? 50%. And if you look, and next time that news comes out on a stock, do this test for me. Look at what information comes out on a company that drives the price of that stock higher or lower. It always has to do with growth. Growth is the key for picking the right stock to buy. And if you look at these two stocks, even though stock A is a far better company, stock B or company B is the one that you want to consider buying because its growth rate was a 50% growth rate, and what that means is that when its growth rate is moving up that fast, investors will put more money into that stock and its price will move up. After all, think about this as well. There's only one thing that makes a stock's price go higher or lower, and that is the demand for shares for that stock. And the more demand that the investors have for a stock, the higher its price goes. And what do investors want to buy? They want to buy growth. So remember this. You should never buy a stock because of fundamentals. You should use fundamentals to set aside or to pick the group of stocks you might consider buying. So fundamentals tell you what? Technicals, which I'll get into in rule number 3, tell you when. But right now, on rule number 1, I want you to look at the fundamentals of a stock and consider the growth rates of those stocks.